Hello, and thanks for joining us for another episode of our ongoing series, Cash Flow Conversations, sponsored by the folks at Nova Credit. We've spent a lot of time in this series, and rightfully so, focused on what's happening with mainstream adoption of cash flow data within consumer lending. How to build a business case, where to get started, the challenges you can expect to face along the way, and how to overcome them. For today's conversation, I wanted to do something a little different. I wanted to leave the center of the cash flow lending universe and jet out to the outer edges, the frontier, where the conversations aren't about business cases and operational realities, but are instead focused on what's coming next, the theoretical, the questions that we know are important because we don't yet know the exact right answers to them. I couldn't think of anyone better to have this conversation with than Nikki Cross, head of data science consulting at Nova Credit. Nikki has forgotten more about credit risk, model building, loan underwriting, and cash flow data than I will ever know. In our conversation, we talk about the development of custom scores in cash flow lending and why it's difficult for even the most sophisticated lender to start there on day one, fair lending, and how to navigate compliance concerns within an entirely new universe of data, and, of course, because it's 2026 and we have to, AI. There were lots of interesting ideas expressed, lots of analogies taken way too far, a computer that crashed halfway through that we managed to muddle our way through, and of course, lots of laughs. I enjoyed the conversation immensely, and I'm sure that you will too. So here it is, the latest episode of our series, Cash Flow Conversations. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Nikki, thanks so much for joining me.
Thanks for having me.
I am delighted to have you. You've been on the podcast before. We've done events together before, and because I've gotten to know you, I know for a fact that you are the exact right person to just have a very open-ended, sort of unguided conversation about the interesting stuff happening in cash flow. So this is going to be a relatively unstructured conversation that touches on a bunch of different areas. The first one I wanted to ask you about is what's happening in the world of cash flow scoring. Because I obviously come from a credit scoring background. I know you've spent a long time sort of implementing, evaluating, possibly getting frustrated with different scores, whether it's vendor scores or internal scores. So you've wrestled with this issue a lot. I guess as sort of an opening context setting, I have found it very interesting that as we've entered the world of cash flow underwriting, and I think we really have. It's now a mainstream topic that everyone talks about. The event that I'm at this week actually has come up multiple times. There has been a real proliferation of new scores that have entered the market. Some of them are sort of revamped versions of things we've seen before from the bureaus or FICO. Some of them are sort of fundamentally new products. And what I find interesting about that is I wasn't around in the industry, at least, when the FICO score was being initially rolled out to lenders. The sense I have, having studied the history, is that there really wasn't the same competition back then, right? It was kind of one score, one company was doing it. There weren't a lot of choices. That's why we all sort of standardized on that score so quickly. By contrast, today lenders have a lot of different choices. We also see a number of lenders, both banks and fintech companies, building their own scores, which, if you know credit underwriting, you know that a lot of lenders already do that with credit bureau data and building their own scores and building their own attributes. So not necessarily a new behavior, but a new set of data to look at, whether it's first party on us data or off us data. So how would you characterize kind of how lenders are evaluating the different options they have when it comes to models and scores based on cash flow data?
Yeah, I would say that to your point, when FICO scores first came out and early in the credit scoring space, what you had were a lot of companies who didn't necessarily know how to build their own, right? So you, at that time, right, the intelligence and the computing resources that it took to build something like that, the history you had to have was much more complicated than it necessarily is today. And so FICO did pioneer that because they had the right data scientists and statisticians, as they were called back then, and things like that to kind of define what that looked like in the industry. But as everyone adopted the idea of credit scores and created their own custom ones and leverages, any of the dozens that are available from each of the bureaus, everybody now sort of knows what it means to build that score. And there is an expectation that if you're a relatively sophisticated shop, you're going to have the ability to build that kind of score. The trick with consumer permission data is, do you have the actual assets to be able to do it? And so I think that's a little bit of the arms race that I think we see in the industry right now, is that in a consumer permission space, it's not as easy as going and getting a retro of 2 million applications and then building your own, which many organizations would probably choose to do if they had access to that data. That consumer permission element really changes like what is possible, and it changes the way that lenders and different clients will think about how they have to test into the space and how they get comfortable there. And so I think that's why we see so many scores in the industry, is it's because unless you've got a really robust set of cash flow data already sitting there, it does become more challenging to build your own score initially. And so it sort of puts some of our lenders, maybe 2 years behind the curve of where they would want to be if they had an option there. Some of the other alternative data that has been in the space, as that curve has kind of gone in the past 10 years, it did have that retro capability, did have the ability to sort of immediately jump into custom scoring. So I think what you're seeing is not necessarily a difference of intent in what a lender would like to do. It's a data availability reality that they're accommodating for right now.
That is a really great way of explaining it, because to your point, like if you're a large enough and sophisticated enough lender, you know that a purpose-built score for your business, your product, your customer segment is always going to outperform a general score, right? Like that's just the reality. If you have the resources and the scale, it just makes sense to build your own score. I was always amused when banks would like brag to FICO about like, well, we built a score that outperforms FICO. It's like, well, of course you did. You're just building for one, like
right.
a general purpose score by definition can't outperform an institution specific score unless the institution has no idea what they're doing, which to your earlier point, this knowledge of how to do this is democratized across the industry in a way that it wasn't in the late 80s, early 90s. So I think that's a very, very good way of putting it. And, to your point about like the retros and the data, I guess a question I would have for you is, and this is something I've always been curious about. We talk a lot about like off us versus on us data, right? And the distinction between lenders that have a real like robust deposit franchise who might be able to start by using on us data from an implementation perspective, rather than the off us data where they have to acquire it through an open banking data aggregator. The thing I am curious though about as it relates to modeling and analytic development, just because you have on us data might not necessarily mean that you have enough data or the data sort of captured in the right fashion in order to do retro analysis and to build your own custom score and attributes from day one. Is that a fair assumption?
Yeah, I think that there's a couple of ways of looking at that. So one is you can have a robust set of data and just not the right resources to actually go mine that, right? So when we think about the difference in receiving like bureau attributes that are, maybe 2,000 attributes and made for digestion there, and what it takes to go through transaction level data and figure out what do we want to include in this, and what like the intensity of the feature engineering and the categorization that's required to use transaction level data is next level relative to what many organizations have experienced, unless they've like gone through credit card transaction and kind of like, have built some of those custom attributes in that way. And so what you start to see is that there are, to your point, there's an on us and an off us, but even with those who have enough on us data, there is what's the resources that are required just to get to a functional attribute set, because that is a very non-trivial hurdle in that space. Certainly for folks who have on us, we also see folks who have got, you had a thing where you had to have a $5 deposit into an account before we would lend to you. You may have something on that consumer. You may have an account, but it doesn't necessarily mean you have the primary. It doesn't necessarily mean you have the totality of what the inflows are for that consumer. And so you may have something, you may not have enough to actually generate the risk read that you want. which is another sort of bifurcation in the way that we think about who that consumer is and how you bring that. And so for some of those institutions that do have on us, they may have done some pretty basic work in cash flow where you had to have a minimum level of account deposit in order to be able to get a better term or things like that. But the office is where the magic is, because that's the thing that, regardless of how proficient you may have been internally, that you've been blind to. And it certainly depends, a little bit on a consumer's circumstances. They may have multiple accounts because they have a personal and a joint. They may have one account that some of their gig work goes into, and another one that's shared. There are all sorts of reasons that people may choose to compartmentalize those. That it's not that world where you go into your local branch and you get your credit card and your accounts and everything sits with this one institution. In a world where folks have, I get like probably 3 pieces of mail a week that tell me I can have $300 or $500 for going and opening up a new checking account. There's just not that loyalty, and there's not, in many cases, the centralization of those accounts, particularly between deposits and lending. So deposits, often you might have checking, savings at the same place, that sort of thing. But you don't necessarily go to your deposit institution for your credit card anymore. And so when you start to disaggregate those, that's where the importance of those pieces. The Honest is great as a starting point for figuring out how do you set some of your strategies, how do you think about it, for convincing yourself that cash flow underwriting is important and getting a running start into that policy. But the office is what gives you the complete picture of that consumer. And it does require a little more friction, but it is going to give you a better lens into what you actually are trying to get at, which is, who is this person as a whole?
Yeah, I mean, that makes a ton of sense. And I think maybe to sort of reflect what you said back to you, and correct me if I get any of this wrong, but like, I think it sort of gives you an appreciation for the benefits of credit bureau data, as much as like there's flaws or gaps or things that it doesn't do. Like I oftentimes find myself sort of reflecting when I talk about cash flow intelligence on, the credit bureaus are optimized to do one job, but they do it really well, right? Like the data is comprehensive, to your point, right? So it's not like, oh, this is our view of the consumer from a first party perspective, but that's probably not inclusive of all the relationships that they have. Credit bureau data is aggregated from everyone. And so they have really good coverage of a consumer. To your point about like the split between deposits and lending, even things like how easy is it to tie this deposit data that we have to like lending outcomes with that consumer over time, right? Like all of that is contained in one file in a credit bureau. So it's just very simple. And I think the other thing that you described that I just want to emphasize is, the proficiency that people have with credit data, with credit bureau data, is just very high, right? Like people know what a file looks like. They know how to parse trade lines. They know what data elements to expect. They know how to engineer features based off of that. I mean, it's funny, you go back in time to like when Capital One was like breaking people's brains with their very sophisticated probability models and, propensity models and like, the level of feature engineering they were doing was very, very sophisticated for the time, but it was also very narrow in the sense that like they were finding ways to extract 5% out of a data element in their feature engineering that everyone else had already squeezed 95% out of the value. And that 5% relative to what everyone else was doing was hugely valuable. But it's like now we have this orchard filled with all of these data elements that like people don't recognize. They don't know what they look like. They don't know like what relative like level of predictive value. Like, I mean, I like the orchard analogy because it's like, I'm not grabbing one piece of fruit off of one tree and trying to squeeze 5% more juice out of it. I'm looking across an orchard going like, what section of the orchard should I pick? Which tree should I climb into? Which fruit should I pick off of the tree? And then trying to figure it out. So it's just the scale of the problem is very, very different, it feels like.
Yeah. And the thing that I think is really interesting about it, and I'm gonna try to follow that analogy and see if I can find the right one, right? You're looking at an orchard, but the thing that you also have to remember is that like you've had one tree in your backyard since you grew up, right? Like everybody has an intuition about cash flow because I know how I manage mine and I know how the people that I talk to. And it's a really interesting thing as we're in and out with banks and lenders because I get people who ask very specific questions and things. And part of what I'll say is like, I want you to take 10 steps back, right? Like, and if that's the way you manage your accounts, like I was at Capital One for almost 10 years, including when we started buying banks. And so do I have 4 Capital One checking accounts? Yes. Does the average person have 4 Capital One checking accounts? No.
Right.
The way
right.
that my life has come together in these ways looks different than the average consumer. And so I think that's when we think about the orchard that is there, everyone has an intuition because they get what cash flow data means. It's all incredibly intuitive in ways that bureau data isn't always, even to people in our industry. But it also means that we kind of have those conversations sometimes of like, you are a highly educated, well-paid person who works in this industry. And so you've probably also got 4 checking accounts because you were part of a test case and this and that. And you've got to remember what this looks like for the average consumer. And so it becomes tricky sometimes where people want to immediately get to a very granular level and say, because I understand all of this, because I know how trees work, I want to make sure I'm solving for all of these problems. And you're like, yeah, but most people don't think about this orchard the same way you do. And so let's make sure that we're really covering a broad base of how 95% of Americans, and will we get to that point where you're milking the last 5%? 100% we're going to get there. But let's make sure that we're covering the vast majority of how average consumers interact right now. And then we're going to get to those edge cases and get to that nuance. So it's an interesting space because there is an intuition, but disproportionate to the way we think of bureau data, sometimes our intuition is wrong simply because we are in the industry and because we have over-engineered our own financial lives. So it's an interesting case study sometimes walking into some of my clients.
That's fascinating because, you're right. Like credit bureau data is like exogenous to all of our day-to-day experiences. Like unless you've worked in credit risk, you've never looked at a credit file. You've never I would encourage people who really want to understand like credit bureaus to just build attributes someday just for fun. I did that early in my career, and like it's mind-numbingly specific and very abstract at the same time work because you're working with these data elements that just bear very little resemblance to your experience interacting with the financial industry. And so you're right, you don't have that intuition. And on one level, that makes it harder, right? Like I think experienced credit risk folks who start to understand the relationship between credit bureau variables and performance develop a good intuition over time, but they don't walk in the door with that. You have to learn it, right? Like that was Capital One for decades, was just like, this is where you go to start your career learning to develop an intuition about credit bureau data.
Right.
Whereas with cash flow data.
I did it.
Right. Yeah. Like, it's so funny. Everyone I talk to who knows anything about this, like, I worked at Capital One early in my career. Like, this is where that experience comes from for so much of the industry. And yet at the same time, I think the cash flow thing, you have an intuition walking in the door because it's like, I manage my cash flow this way. So maybe like a feature that's engineered this way would work. But the risk you run is actually the same risk you run in like personal financial management, where I'm building a PFM app for the way I think about money, but it's not representative of the whole market. And it's funny, I've never heard someone express that idea specifically with cash flow. Let me ask you about attributes or features or what have you. I call them attributes because I'm old. But the the thing that I'm curious about is, historically, I think the split that you had in traditional credit bureau land was, do you want to buy an off-the-shelf score? Do you want to buy an off-the-shelf score and use that score entirely as an attribute into a model that you build filled with a bunch of other custom features and custom attributes? Or do you want to sort of construct your own custom model, but mostly using attributes that we provide you? And all of the credit bureaus, FICO, a bunch of other providers in the space over years have developed like very robust libraries of 300, 400, 500 tri-bureau attributes that are all sliced in slightly different ways. And it's a little bit like here's another analogy, but it's like the Cisco truck comes to your restaurant and drops stuff off, and it's roughly the same raw ingredients depending on how much you spend to get, breaded onion rings versus beer battered onion rings, but like roughly you're dealing with the same things. And then the art is combining them together in your kitchen, as opposed to like farm to table where I'm sourcing all the ingredients myself. I'm curious, it sounds like the farm to table approach to model development in cash flow is really hard because of that lack of data and lack of experience. Do you see more sophisticated lenders saying, all right, well, maybe we're not going to build everything from scratch, but we at least want to take a look at the attributes you've developed and use that as a starting place? Like, where's the division there?
Yeah, I think that that's the right way to think about it, because I would say like almost the attributes is a little bit of the farm to table, and then the if you're going to take the transaction data, that's you now have to go till the ground and plant the seeds and grow the right. Like
That's a good
that's
analogy.
even beyond the farm, right? Like you have to go build a farm. And that's the thing. If you think about the volume of that transaction data, how messy it is. The example we used for years and years was that Doctors Without Borders would often get labeled as a restaurant because it was getting confused with Border Grill.
Oh,
and those are different things. I think you'll find.
Very different.
And so there's nuance like that, like just that level of trying to get to the granularity there, and to categorize. And when you think about income and what's an inflow versus income and all of those sorts of things, it just gets very, very messy. And so what I think most folks are doing is, to one of your earlier points, right? Like use an off-the-shelf score as a benchmark. You should be able to do better than that. I'll never fight anybody who does. It's a question of how much better, right? But I want you to use our score as that starting point to say, this is a reasonable approach. I can maybe do better, but like certainly I could do a lot worse than not using a solution like this. For those who have enough data to be able to create some strategies, we'll often see an attributes-based strategy or a combination. So I'm going to create a score threshold. And then a lot of lenders like to have those like red flag backstops. So I'm going to use a score, but also if you have a negative balance today, that's a hard cut too. Right. So you kind of get that combination. And I think where we'll go will be more and more folks using attributes into their own custom scores. But the majority of folks are still using a score today, depending on, I will always jokingly ask, how scared are you of your model risk management team? But that, right, like there's sometimes overhead that will prevent or deter. I'll say deter somebody from using a score immediately. But right now, simply because getting that intuition, getting that understanding, getting your own performance, it takes time in a way that traditional bureau data doesn't. Scores, I think, are disproportionately the better adoption path right now for where most lenders are. Most lenders are coming in because it's got intelligence baked in. It's got things that you haven't seen, and that just makes it a better starting point. But we will, as you expect with all things, the big lenders, the ones who have the data, who are able to season, and even we see some of our short-term lenders who, like in a credit card world, you may be looking at 12, 18, 24 months, same for personal loans. BNPL, shorter term loans, you're like, hey, 4 to 6 weeks, I know what happened and I can evolve my strategy quickly.
Yeah.
And so where you've got that luxury of a very quick turn time, a very quick delinquency cycle, you will evolve, and those folks will probably get to custom strategies much more quickly. And so it is an interesting balance of the data that is available, how quick your learning cycles are. So we'll get to a normalized place where folks are more sophisticated, but the scores do tend to be disproportionately useful right now just because of the structure of the data and what people, do and don't think they know right now.
Yeah, I mean, the level to which there's just like wisdom and experience built into models, I think is oftentimes underappreciated, where it's like, we just know this data really well. And if you've never spent time kind of just like pouring through this data and running into problems like Border Grill versus Doctors Without Borders, another example I heard recently was transactions for sports betting being miscategorized as transactions for like early childhood education because they use the word play. And it's like, that's a huge difference, right? Like from a credit risk perspective, if I'm going to be building a model and it's weighting, play-oriented transactions as investments in early childhood education versus sports betting, like those could not be more different in terms of risk profile, but the categorization might confuse those, right? So you have to have a certain amount of like wisdom and experience and scar tissue, quite frankly, to be able to sort of recognize those differences. So I do think it is wise by many lenders to step carefully into this world. And if your model risk management team has anything to say about it, they'll be like, okay, like let's just ease our way into this. The other thing I wanted to ask you about real quickly before we get back to model risk management, because I have some questions on kind of the compliance front, is what do you think the consumer impact of this is going to be? Because I think the other thing that we're wrestling with just broadly is this move from, okay, the FICO score is not perfect. It's a little confusing. Like, why do inquiries matter? Like, this is weird, whatever. But at least it was one number, one system, one sort of way of thinking about your credit worthiness that was directionally useful for helping you understand sort of what was happening with your financial health and your ability to get credit. This is not necessarily the world we're stepping into, where we still obviously have the credit bureaus, we have the FICO score. we have more competition now for the FICO score with Vantage and Mortgage and some of the stuff we're seeing there. And from the bureaus, from FICO, from Nova Credit, from a whole bunch of different providers, we have other scores that are being used by lenders, maybe in combination. Have you seen any early indicators of like how you think this might play out on the consumer front in terms of like consumer education, guidance, understanding your credit worthiness, or are we just too early to know kind of how that's going to shake out?
I think we are interesting a little bit early in knowing how it shakes out, but what we do know is that this is what is most intuitive to consumers, right? Like this is the thing that consumers have been saying is you're decisioning this based off of, a report that I don't really understand and check, but Credit Karma has told me, because that was kind of the first place a lot of people started monitoring,
Totally.
right? Like I have some idea of how to change this. I don't always know why that changes it in one direction or another, but like I now have these places where I can monitor my scores. They're different scores. I also don't know why that is. But I have directionality in a couple of different places that are now much more publicly available than they were certainly 10 or 15 years ago. So consumers have adapted to the framework that the industry told them they had to.
Yeah.
And this is almost the exact opposite, right? If you ask a consumer, how do you measure your financial health? The balance in their checking accounts where almost everyone's going to start. And it is the place where it's most intuitive to the consumer. You don't have to explain to them how do you dispute something on your credit bureau and go through and do like I know what to do if there's something wrong in my deposit account, right? I know who I call. I know what that looks
and
like.
Quite frankly, I'm going to call because of other reasons, not the impact on my credit availability, right? Like there's a
Right.
more urgent reason for making sure my bank balance is correct.
Right. And so when we think about like what is consumer there certainly will be consumer education. Anytime there's a score, anytime there's a decision, there's going to be a Reddit thread and there's going to be gamification and there's going to be all of those things.
Mm-hmm.
But the beauty of what this is like this is what consumers have said, for decades, which is why am I being punished because I don't use credit, right? Like I've not messed anything up. I have, these balances in my checking account. Why doesn't that count for anything?
I pay my
and
bills
it
on time.
hasn't
Yeah.
in a credit world, right? Because that's not how that world was built. And so we're never saying that folks need to disregard all credit, but like when we think about how this all comes together, it is a much more consumer friendly, it's a much more consumer intuitive way of judging what that looks like, what their risk is. And so you're not going to need, I think, in the same ways that you do to help a consumer understand their credit history, understand how to dispute and tell them that they should, look at their credit bureau once a year, we're going to make it free.
Mm-hmm.
People are already for free checking out what's in their deposit accounts and how they react to that. And so I think that's the difference is that we don't have as much sophisticated education because you really don't need it, right? Like the consumer is already educated, already intuitive in this. And so it is a much more consumer friendly way to approach this because it's now us coming back to how the consumer manages their lives as opposed to forcing them into the paradigm that an industry has built around them, not for them.
Yeah, I think that's a really good way of describing it. And to add to that, I think the other thing that's going to be beneficial as we move into this world is we will stop torturing certain data variables that really aren't telling us the thing we think they're telling us. I mean, I always go back to inquiries as the example of this, where it's like, this is such a lagging and noisy indicator of what we're actually trying to measure here that there are way better and quite frankly, more intuitive ways to measure it that I think as you balance out, like no one is saying the credit bureau data is going to go away. Like it's incredibly useful, but to use the fancy data science term, like it's orthogonal to the other data you're getting from cash flow, the other insights. And once we balance out the analytic weight across those two sources of data, I think it's going to make much more intuitive sense to consumers what's hurting them and what's helping them, as opposed to, you'd see the same thing, by the way, on cash flow. If we asked cash flow to do stuff that is not really set up to do well, you get those same like unintuitive signals that then you have to do a $10 million advertising campaign to explain to consumers like why this matters. Like not having to explain the model because the model is most intuitive to things that people understand and that people think are fair is, I think, really, really important, because if you don't do that, then that's where you have to like go overboard explaining. And I think, to be fair, like the Credit Karmas of the world have built a really good business on how unintuitive credit scoring and the credit bureaus in that world is. But that doesn't necessarily mean that it's the right solution for consumers.
Right. And absolutely no disrespect to Credit Karma, right?
Yeah.
They solved a niche and a problem that was there because the world of lending and credit scores and all that was so obfuscated for so many consumers for so long,
Mhm.
right? Even those of us in the industry, right, typically don't check our reports every year. We may not look at those things, but like I got asked all the time when I was starting out at Capital. So explain to me, how does this work? And so like Credit Karma has absolutely gone into a need that was there for the consumer to help me understand this thing that a lot of people didn't want to tell me about for a long time. And even now that it is forced to be available by regulation, I still can't understand it, right? Like they took that explanatory path to correct for an issue the industry created for decades. And so like this is just an opportunity to really reverse that and say we're going to start with the way the consumer thinks about their finances, and now we're going to codify that.
This episode is brought to you by Nova Credit. Every lender wants better credit data, but most don't need more data, they need more connected data. Nova Credit's FCRA compliant platform gives you unified access to credit signals across global credit bureaus, bank transaction data, payroll providers, and verified documents. If you're expanding into cash flow underwriting or reaching cross-border borrowers, Nova Credit makes the complex stuff of credit data usable. Learn more at novacredit.com. That makes all the sense in the world. Very related to what we've been talking about in terms of feature engineering and model design is obviously compliance. And you mentioned model risk management, which is an area that I've been digging into recently, as a matter of fact, because I think on the one hand there is a recognition that a lot of what we're working on right now and a lot of the new technologies and new capabilities that are coming into lending, whether it's cash flow data, which we've been talking about, AI, which I promise we will talk about soon. There seems to be, I think, on one level, a recognition from policymakers and regulators that maybe not everything that we've been doing is going to fit with kind of where we're going, and we need to have some level of flexibility when dealing with that. In fact, the regulatory agency's updated model risk management guidance really specifically seems to emphasize like we want to give lenders more flexibility. We want to allow them to sort of approach this more from a principles-based direction rather than like a very prescriptive rules-based direction. Obviously, we've seen a lot of sort of new movement in the world of like new companies becoming CRAs and like what does the Fair Credit Reporting Act mean in a cash flow world? The other angle to all of this, and maybe the sharpest angle to this, and I really want to get your take on this, Nikki, is fair lending, right? Which is on one level, like principally has not changed at all, right? Like we still are trying to achieve the same principles that were sort of laid down in the Equal Credit Opportunity Act, 40 plus years ago. On the other hand, I do think that cash flow data presents some really interesting fair lending questions because,
Right.
again, we were talking about the sort of like underappreciated aspects of credit bureau data. I think one of the underappreciated aspects of credit bureau data is there's really nothing in there that directly relates to like demographic information or protected classes at all, right? I mean, it's rigorously stripped of a lot of that stuff. I've used the analogy before of like the screen that they started putting up when you would audition to join an orchestra, right? Where it's like, we can't see the musician. We can't take any of their sort of demographic characteristics into consideration. We can just listen to the music being played. And by contrast, cash flow data, well, it's not directly giving like demographic information. I think reasonably it could be inferred a lot easier just based on like, I don't know, in conversations I've had with people before, just things like grocery stores, for example, like where you shop often can be a much more directly correlated to different protected classes. And so I'm really curious to get your take on like how to think about and how the lenders you're talking to are thinking about fair lending and sort of regulatory compliance more broadly as it relates to cash flow. Because part of the benefit to cash flow data is we have all these other data attributes. We have things we can look at that are highly predictive that just weren't in credit files that tell us different things about what borrowers are doing. But on the other hand, there's also kind of a new minefield of things to be careful of when you're sort of stepping
Right.
through all of that data. So what's the sort of philosophy for how to tackle that?
Yeah, and one thing I'll even take one step back in terms of the way that you frame that is that even within bureau data, like there are lenders who won't use presence of mortgage, for example, because that can be tied to redlining and historical issues in the U.S., which is, we're decades removed from that being codified, but there are still implications. So I think that when we think about the difference in the disparate treatment impact and some of the changes that have come there, even bureau data, which on the surface is so removed from any sort of protected class, there are still examples where major lenders are still uncomfortable with some of the legacy of racial decisions and codification that was made in the U.S. And so I think that becomes, to your point, infinitely more complicated when we start to think about the nuances of transaction data, what cash flow starts to look like, and where there can be landmines. So I do think it's incredibly important for lenders to think about that. And that's choices that I would say every cash flow underwriting organization is having to think through a little bit differently based on the amount of data they have. Where do you even have good information to try to discern protected classes, right? Because certainly that's something that most data providers don't have in-house. They're not trying to look at or have access to in many ways. But also, to your point, right, it's not even just like which grocery store you're shopping at. It's a matter of like how much do you spend on fast food versus restaurants versus grocery stores. And so I will say, like, while this is not a pitch for Nova Credit necessarily, right, that's a choice that we've made in the way that we think about how we design our attributes, is that we want to ensure that we are being as high level as possible in many of those regards to ensure that we're not getting into unintended spaces. And so I think it is something that every lender has to think about. Everybody who is a peer of mine in the cash flow space has to decide, like, what's their philosophy and the way that they think about that. Because there is a ton of information when you've got billions and trillions of transactions that you can mine. The question becomes, what do you do with all that power, and should you? And you get to a place of having ratios that you can't explain, of why does your ratio of gambling to restaurants, like, why is that the thing that's most powerful? We can't really quite explain that. And so I think that there are things there, and that's just an example I've made up to be clear. But that's the thing that we have to get into and have to really start to think about. And I think it's a choice. And what we hear from most lenders is they never want to be the first one to try to explain something like that to a regulator. And so for those reasons, the things that are most intuitive, the things that are most straightforward are the things that, one, generally do rise to the top when we do the analytical analysis to understand what are the things that we're going to build into the first version of a credit policy, things like that. But it does make it even more powerful as you start to think about how you evolve, how you do your second generation, third generation of policy, to be able to do that testing, to have that information on your own booked accounts, because you can't really look at cash flow by itself. You need to look at it in terms of, if you've got this down waterfall from your credit policy, you're already building in biases and who's coming into your cash flow second look policy, for example. You've already got all sorts of other decisions that you're making in terms of fraud and who's being pulled out of this. And so looking at that holistically is incredibly important, because there can be landmines. And it does mean that most of our lenders are defaulting to things that feel very intuitive, that on the surface are above reproach. And the reason that a lot of folks don't want to get to that level of granularity that they just can't get comfortable with, and that they're not prepared to defend to a regulator.
Yeah, it's really interesting. I mean, the can you explain this, can you defend this question is so fascinating to me, because I think on one level, we've always kind of dealt with a version of this, right? Which is that, like, hey, can you explain this? And it doesn't really make sense, but the model says that it makes sense. And like, you're sort of trying to be like, I mean, again, I go back to inquiries as like, it's just predictive based on the data that we have. And like, we can't really, we can kind of explain it, but we can't totally explain it. There's lots of things like that. And I think to a degree, we just get comfortable with things over time, right? And so I'm curious how much of this is new. We need to sort of step slowly into this world versus, and I think this gets to your point about granularity, there probably is a level to which data can be predictive, but just not seen as fair. And I think it's not even necessarily the disparate impact part of it or disparate treatment, which is obviously, we're seeing lots of regulatory fluctuations around that right now. But even even in a broader sense, like if you set that aside, I just think like there are certain things that when you tell a consumer, hey, we're declining you for credit and here's why, and you're required to offer an explanation, there are certain things that are going to seem intuitively fair and certain things that aren't, right? And like, hey, the amount of money that you spend relative to how much money you bring in, that ratio is just not good enough. Like, okay, fair. You missed these payments. You have a history of missed payments recently. Fair. You shop at this grocery store or you go out to eat too much at fast food restaurants. It's not that these things can't be predictive variables, but there is a level to which that predictive versus fairness trade-off seems to tip the wrong way. And I guess what I hear you saying is it sounds like lenders are being very cautious as they walk down to that level of granularity with this idea of like, just inherently, does this feel fair? Is that accurate?
I think so. And I think when we think about what it means to use a credit report to make decisions, we kind of base that on the idea that access to credit was itself fair, right? So we have to assume that the issuance of all of the trades you've previously gotten are based upon people making reasonable and sound decisions. When we look at things like cash flow and the difference in the way you might manage your finances as a person, which is to say, I want to spend less on fast food and more on groceries.
Sure.
That looks different than the way you think about it as a lender. And that becomes part of the way that you think about that is accessibility. And then that's where we start to get back into the history of redlining and things like, like urban food deserts and those sorts of things, right? All have so many ties in. And so in a world where we think like what has come in and was part of your credit report had that all built into it, and it is all foundational upon your performance and your credit worthiness, so much of what's happening in your transaction history is a function of where you live. It can be your financial choices, right? Like there's all sorts of, I'm originally from rural Georgia. I live in Santa Monica. My life, like how fast my Amazon packages get here versus my mom's, right? Like all sorts of things factor into how you make those choices. And those aren't necessarily, to your point, like in the truest sense, they're not fair for us to think about that because the stores that I have at my disposal look very different than the ones that are in my hometown and are the choices that folks might make there. And so I think we have to think about that differently because there is an entire like driver system underneath where this data comes from and how those choices are made that looks very different than traditional lending products and the way a consumer has access to those.
That makes a lot of sense. The other thing I wanted to circle back on that you mentioned before was thinking holistically, right, about the entire system. And I think this actually gets a lot of isn't discussed maybe as much as it should be, which is we worry so much. I mean, model risk management, there's the name right there. We use model risk management as the framework for like, are we designing this in a responsible, sort of well-managed way? And yet, a lot of things depend more, I think, on the sequencing of when you do certain things and in what order, right? And I guess like an example of this would be as we step slowly into the world of cash flow underwriting, we step carefully into the world of cash flow underwriting, it seems as though even things like sequencing and where we use this data will matter a great deal, right? Like one of the ones that comes up a lot when I talk to credit risk and compliance folks is, like, are we using this data as a knockout? Are we using this data as a way to approve people in a second look fashion? Like even things like that then determine, okay, what's the declination reason? What's the adverse action that I have to give to someone? I would imagine that, again, early days where we're all kind of getting used to this and figuring out what we think is fair and what's not, which is, I should say, a decision that we are making as a group, as a society, right? Like no one of us gets to decide like, this is how this is going to work. We have to kind of feel it out slowly as a group over time. It feels like in the short term, even those sequencing decisions are like, we're going to use it where we think we can help approve more people and give people what they want. We're going to use this over here more as a knockout, partially because we think this is fair and better understood and more defensible in at least the short term. So even like, does this show up in sequencing and kind of system design discussions as well?
Yeah, absolutely. Because we get a lot of folks who will say, hey, well, tell me like what you think my approval rate will be. And I'm like, well, if you're going to go down in a second look scenario, 40 Vantage FICO, whatever points, right? Like you're
Sure.
going to get a different approval rate than if you go down 100.
Hmm.
And that's going to look different if your current cut's a 700 versus your cut's a 600, right? There's so many conversations of what happens upstream from the population you're actually going to expose this to.
Sure.
And then you're going to get, your selection biases by who chooses to log in, where you have data availability, all of those things. But right now, it's not a universal solution, right? It's not you're taking a Vantage score and applying it to everybody who walks through your door. You're going to take your cut of 80% of the population that you're already comfortable in your decision with, and then you're probably going to start testing in this much more narrow band. And what you see in that's going to be very different depending on how you define it. So there are a lot more conversations about, well, if I've got somebody who has an 800, I'm not going to ask them for additional friction, or I'm not, even if you tell me that they're currently overdrawn, I'm still not going to decline that application, right? So I think that there's those elements of the strategies I already have. What are my KPIs? What does the success look like? Is it additional approvals? Is it trying to remove some risk? And those things are always very fascinating how they shift, right? Everyone's got their crystal ball about what the recession will be and when it's happening and how much do I care? What have I prepared for? What am I, right? And so those things can all change in a day, right? Like the second you say, all right, we've hit recession, then it's not an expansion strategy that I care most about. It's how do I start to remove some of the riskiest folks, some of those folks who've recently lost a job and I now need to be sensitive to their cash flow. So I think that it's disproportionate to my time in a traditional bureau. It is impactful to think about where you are in that waterfall. What's the population upon which you're applying this data? And then how do you start to think about the second and third order effects that you're getting? Because those can be differentially impactful to the consumer and to what's happening in your analysis.
Yeah, I think that's a great example. And I'm glad you mentioned the sort of macro uncertainty to a lot of this, right? Where it's like, I think the general belief is that this data will be useful sort of across all different credit conditions. Obviously, as it relates to scores and models and stuff, there's a certain amount of historical performance that we just don't have yet. And so we will get to learn a little bit when eventually we sort of see the credit cycle turn in a more meaningful way. The last thing I wanted to ask you about, also thematically tied to uncertainty, is AI. No one listening to this would know this, but we had to interrupt our recording halfway through because my computer decided to shut itself off to install an update. And I had to tell Nikki, I only have 20 seconds to talk to you before my computer says goodbye. Reminds me of a lot of the agentic conversations we're having right now, where it's like, how much should the human be in the loop? How much should the human be able to overpower this machine that's decided to do it for this reason, which we may or may not even fully understand? So I'm living in an agentic reality right now, Nikki, and I guess the question I have for you is two-part. One is the lender side, and one is the consumer side, right? So a useful reminder I always like to give people with AI-related discussions is everyone's going to be using AI, right? So it's like you're not playing tennis against a wall, you're playing tennis against another player on the other side of the court. They have this tool, you have this tool, and you're going back and forth with each other. So starting on one side of the net with consumers, I'm curious how you think consumer usage of AI, agentic AI, we're already starting to see like OpenAI roll out like PFM, personal finance capabilities. So like we are entering this world, whether we want to or not. And, it seems to me like on a baseline level, there are some things that'll just get easier, right? Like permissioning data and managing who's using what data, just like all the benefits of cash flow data also come with a cost of just like friction and overhead and sort of administrative work that at a baseline level, I feel like a properly designed agentic AI system, I could delegate a lot of that work and it could sort of do the moving around of different different solutions and different data points and stuff to give lenders what they need to evaluate me. So on a baseline level, I could see it potentially removing work. To your point, there's second and third order effects to everything in terms of how consumers might use agentic AI, how they might use it to game lenders and sort of like, move data around in different ways. What's been your sort of initial take on how it might affect the consumer side of the equation?
Yeah, I think that it's still early, so certainly I think we're going to get to those places. Right now, I think what we're seeing is mostly things that are generally healthy, right? They're AIs that are helping people understand how they can better budget, how they can increase their balances. Those are things that are, directionally good. We want to make sure that we're not getting to the place of gamifying it so much that you're moving balances in and out, to your two of your own accounts, and then you're just bouncing money back and forth trying to make it seem like income, which is
Yeah.
the thing that we know that people do in income verification sometimes. And so I think that that's the thing that we start to like look for those signals, see where there are opportunities to do things that are silly but are trying to game the system. And so I think on the whole, most of the agentic AI should be good for the consumer because it should be taking care of those things that people just, and I know you've recently been on a personal financial management, a little bit of a rant on some of what that utility is. I read the letters. I do.
I appreciate it. I appreciate that.
And I think that's true, right? Like when we think about who's actively using that, how do we make that easier for a consumer? A lot of AI should be able to make some of that really tedious personal financial management work easier because we should be able to automate more things. We should be able to catch subscriptions that people don't care about anymore, right? So there should be like a genuine good boost for the consumer. But we have to keep an eye on what that gamification looks like. And ultimately, as long as we're moving in the right direction, we're trying to help increase balances, we're trying to better balance inflows, outflows, then everyone should win in those scenarios.
Yeah, that I think sounds right. I will add to that and this is a newsletter I haven't written yet. At some point, I probably will. But I do think that this auto pay on steroids idea is kind of interesting, right? Like one of the things I've noodled on in the past is like how much did the invention of auto pay, which we don't really think much about, like how much did that improve people's credit scores, right? Because like I am a responsible but sloppy person. I probably appear better to lenders than I should because of like tools that make me appear less sloppy, even though they are roughly expressing my intent to try to be responsible.
Right.
And, I think that like AutoPay is a small example of that. Agentic AI is a large example of that, right? Like agentic AI can manage my finances in a way that sands a lot of the rough edges of Alex off, and so
but
I'm
if you
very
allow
curious.
it to, do I care, right?
Well,
do I
that's the
care
thing.
if you're pushing every button or do I just care that the button gets pushed?
That's the thing. And how much is it expressing like my genuine desire to live responsibly, even though like life is complex and I sometimes forget to make a payment. So
Right.
I do think we are going to be presented with some really interesting kind of first principles type questions around, the word that consumer advocates hate in sort of the lending vocabulary is like character, one of the C's of credit. Like, what does that mean? What are you trying to capture there? And I think that there are some really interesting questions. Of course, the other side to all of this is like what lenders are going to do, what they're already doing. I think it depends a lot on who you talk to, right? If you are talking to very, very sophisticated, early stage fintech startup doing lending, their answer to what they're doing with AI is going to be very different than if you talk to a community bank. So,
Yes.
accepting that there's a wide range of different possible answers, I was in a session this morning at an event, and so a speaker from a big bank, and they were talking about the fact that we've been referencing like model risk management. The new model risk management guidance that's been released de-scopes generative AI and LLMs and agentic AI out of model risk management, recognizing that the technology is fundamentally different than how like machine learning works. And, for example, it's, probabilistic. It's not deterministic. So it might do funny things from time to time, like delete your database of all customer information, even though you told it not to, or what have you. So I think it's a fundamentally different type of technology. It also has a great deal of utility, right? I mean, even simple things, again, like transaction categorization. Transaction categorization is actually really hard. And we've given examples of like, Border Grill versus Doctors Without Borders, or Play. Does that mean childcare? Does that mean gambling? Like, understanding context and nuance and being able to parse sort of unstructured or badly structured data. Like, there's low-hanging fruit to be plucked there, all the way to the sort of future Jetsons-y sort of world. For young listeners, the Jetsons was a television show that portrayed a future that we sometimes still don't totally have. like the future looking version is more, I would say, like, hey, why don't we just turn our model development over to an LLM and tell it what we want in terms of outcomes and let it do the art and the science of like using machine learning to figure out what variables to pay attention to and do feature engineering. It spans a wide gamut. So I'm curious where you see lenders kind of dipping their toes in now, and then any interesting impacts of AI on cash flow specifically.
Yeah, I think that we've gotten a few things, like to your point, it does vary greatly depending upon the organization you're talking to. I think most of what we're seeing is folks trying to figure out for collections, for some of their customer engagement, things like that. Like, where can we use that to make smarter decisions that don't necessarily have to be explainable? I still get a ton of questions and RFPs, and as we go through model risk management of what aren't you doing, and that human in the loop is still so critical on anything that has to be explainable.
Yeah.
And so the idea that we're letting anything run and not having a human in the loop is terrifying to 97% of the organizations that I talk to. And so the answer has to be like, no AI, no AI is happening, that you're not. And so what I think will happen is we're going to get into a place where people are using it for research, they're using it for discovery, and like, so if AI does find an attribute that we think is of interest, okay, can we pull that out and say, what does that actually mean on a human level, right? I think that there's a lot of data processing that can happen using that. And so we might start to find nuggets, but again, if they're not nuggets that we can justify and explain, then they're not useful in the way that we need to function in this environment. And so I think that's what I'm seeing most, is that there are research projects and they're trying to find things that we can justify bringing research into actual utility in a production setting.
Yeah, that makes sense. I mean, we talk about human in the loop, but like loops also exist between like a research loop and then a production loop. And like, that's there's a very strong firewall between those two inside of banks and lenders. And that firewall exists for a reason. And it does feel like we're a ways away from AI in a meaningful way, jumping from kind of the research loop to the production loop, at least for credit decisions, right? Other things, you're already starting to see examples, but core credit decisions feels like that's going to be a while.
Yeah, I think so. I think like where we are with the recent changes that have come out in regulation and some of those shifts, there's still a lot of people who are holding their breath to say, what if this holds in another administration? What if this holds with different? And so I think that's what I'm seeing is a lot of folks who are very careful about overcorrecting. So folks who've been in the industry for a long time know that things ebb and flow, but we think that the trajectory is probably going to bend this way. And so I think that's what I'm seeing most is folks who are saying, okay, like I understand this is what's happening today at a national level, but depending on what California does with the bringing Rohit Chopra into leadership and that, right? Like you end up in this place where the states start to do things. And so then de facto, if half a dozen states have done it, it does become a thing that you now have to honor on an almost national level by a function of running a large organization. So I think we're getting a lot of that caution right now, in that there are things that are moving. I'm not willing to take any of these as the way things will always be moving forward, because there can be just so much flexibility. There's so much that's reactionary right now, geopolitically and in the regulatory environment, that it is very much a steady as she goes kind of take, because people aren't certain that what's happening today, this month, this week, are necessarily going to be indicative of where we are in 3 to 5 years, which is where a lot of large lenders are building to.
Yeah, well, and to your point, like you just have to be able to explain and defend stuff. Like you just have to, and you have to always put yourself in the mindset of like someone is going to ask you about this, and it might not be the CFPB or the OCC. It might be California or New York, but like someone is going to ask you about this, and if it's not now, it'll be 2 years from now. And by the way, the look back period is actually 5 years, so you're still on the hook for all of these things. So. I think you're absolutely right. And I think that's a great place to leave it. Nikki, a delight as always. Thank you for persisting through my computer challenges and for sharing your expertise with us.
Yeah, thanks so much for having me, Alex. Always a pleasure to chat.
Appreciate it. This episode is brought to you by Nova Credit. Whether you're expanding credit access for newcomers or deepening risk visibility across gaps and beyond, Nova Credit lets you unlock credit bureau, cash flow, and alternative data through a single FCRA-compliant platform built for today's credit decisioning. Learn more at novacredit.com.